Welcome to Eye Level to High Level, where real talk meets real results. I'm Jimmy Rios, and each week we break down the mindset, money moves, and strategies you need to elevate your life and business. Let's level up. Hello, this is Jimmy Rios. Welcome to the Eye Level to High Level program, where real talk meets real results. I'm Jimmy Rios, and each week we're going to break down the mindset, the money moves, and strategies you need to elevate your life and business. Let's level up. Today I have Chris Vale, my CFO. He's also an amazing person that brings a lot of knowledge to our team and to our company. And we have, I know on the first episode, we talked a little bit about a history of RBA and what we're doing with our program, Eye Level to High Level, how it's helped so many people in businesses nationwide, and now actually in Medellin, Colombia as well. Today, we're gonna switch it up a little bit. We're gonna talk a little bit about more in the world of lending, and we're going to dive a little deeper into that world. We're going to talk about a few little nuggets that I think everybody needs to learn. We're very big with Rios Business Advisors in educating, and those that are tuning in and listening, everything that we talk about is going to resonate in some form or format, and we want to make it so that you have questions, you can come and ask us. We're very accessible. Chris, today I wanted to open it up a little bit and dive a little bit into our world of finance and lending, and I wanted to talk about an area that I think is very important, because with interest rates where they are now, right, in the mortgage world, many people that have like a 3% interest rate on their mortgage, they're very hesitant to do anything with their mortgage, right? And so we wanted to talk today about how lenders are navigating equity with different scores, and what are different ways that we look at to be able to help individuals in the world of lending to get away from the traditional, right? And the mindsets that many people have, where they're saying, well, I just can't do it because of this barrier. My scores are too low, or I just can't do it because I don't want to touch my first mortgage. Or let's talk about that. Let's go into a little deeper in using maybe some case studies that we've used or had, or experiences personally or otherwise. Let's talk about that. Tell us, Chris, what is your experience in lending now in the present with regards to equity, and how can we help at Rios Business Funding and Rios Business Advisors?
Thanks, Jimmy. It's great to be back on the podcast. So one of the things that we talked about in our last episode was that traditional ways of getting business funding, right, is typically with other companies, and it could be 0% interest credit cards, or personal loans, or business lines of credit. But and as we mentioned, we're able to help in those as well, right? But where we also take it one step further is we can look into being able to leverage assets. And obviously, one asset that typically most people have more than most is going to be that of real estate, right? It could be their primary residence, it could be an investment property, but usually it's one of those two. And so, as you mentioned, there's a whole lot of people out there that have that 3% mortgage rate because they were able to get that rate, a few years ago. And unfortunately, it's probably going to be several years before we see something like that again, if really ever that low, right? But that doesn't mean that you can't benefit from that, even though you may still have that low interest rate. So what I mean by that is there's a lot of people out there that have a lot of equity in their property, but they may not have, let's say, the perfect credit score, right, to get a traditional HELOC, or they don't have the documentation that they need to be able to do, like, what's quote unquote full documentation, which most banks are going to require. And so in the kind of the alternative lending space, as I refer to it as, which is a massive space, by the way, um, there's a lot less documentation required. There's a lot less requirements required. And not only that, but you have typically, you have your institutional lending, which is still there, but then you also have what's called either hard money lenders or private money lenders, right? And private money lenders and hard money lenders, they're very similar. The biggest difference is that with a private money lender, they're able to kind of um, determine their own criteria, right? Whereas like a hard money lender, is very similar, but they're still structured in terms of what they have to follow in terms of what their criteria is, right? So really that's the biggest difference. But what it allows us to do is it allows us to open up into so many different areas within the real estate space to be able to help that client be able to tap into that funding. Um, Without A, having to touch their low interest first mortgage, B, be able to get that equity out that they need to be able to obtain that funding, and be able to start that process within the I level, the high level process. And so whether it's what happens if they have a low credit score, we're able to work around that. What happens if they don't have tax returns? We're able to work around that. What happens if they don't have, certain documentation that they need, or they're not a W-2 employee, or, a lot of issues that would typically come up when you're doing full documentation that borrowers would not be able to qualify, and now they're stuck, right? That way, what makes us different again is we're able to work with those situations and pretty much have a program that we're able to put each and every one into to be able to qualify in some shape or another. Now, it may not be the most equity that they want to get out at that present time, but if it allows us to get started in that process and then go through the I level, the high level process where they're going to generate that funding over and over and over again, then it's okay if they're not able to take out that maximum equity because of what's going to happen, on the return side with the non-recourse funding that we're able to help them out with.
Yeah, and a lot of people that, especially here in Arizona, are Latino. They might not even have their social security number, but they have an ITIN, they have a business, and they don't know where to go get funds. And we can actually put together programs with ITIN numbers based on assets, right? Based on the equity available in their home. And from experience, I know that many people that buy homes on the private market or private lending, they come in with a much higher down payment because of the funding parameters that are set by private money lenders. Many times these homes are paid off in a very short period of time, so they're sitting on equity. But equity is only, I tell people, it's nice to have a golden trophy sitting in the corner of your house, and it's shiny and it's pretty, but it doesn't do much for you other than stroke your ego, right? Equity is like that. Equity is a nice golden trophy. It shows, hey, I have X amount of money in my house. But the only way you can tap into that resource is selling the house or getting equity from it in the form of a loan. Brian has a saying that money that's sitting in a bank in the form of equity or even in a savings account that is not working for you is unemployed money, right? When you put that money to work where it's working for you and giving you the benefits that you deserve, now you've employed the money, right? So tell us a little bit about inside of our program, getting rid of the fear of using equity because it's your house, right? Why would it be such an advantageous thing to use? And using our I level to high level program, what does I level to high level do for them in being able to use that equity for their goals, whether it be in their business or otherwise?
Right. No, that's a great question. So again, when we're looking to utilize a client's asset, in this example, the real estate, and again, it could be either their primary residence or it could be investment property. It really doesn't matter. We have programs that are able to help with both. As I mentioned earlier, a lot of clients or just a lot of people out there that are listening don't have that quote unquote credit score that's needed, right? So, like for a typical home equity line of credit, which would be a traditional second position, especially with those people that have a very low interest rate, right? That's what they would be looking towards. So they're not refining that first, because if they're refinancing that first, you're now losing that interest rate, right? And so one of the differences with our clients as opposed to everybody else out there that is looking to take out equity is they're very rate sensitive. They want to get out as much as they can. They want the lowest terms or the prepayment penalties or whatever it may be, right? Because again, that's the end game for that person, right? It's going to be, hey, your home equity line of credit could be X, and the interest rate is going to be Y, and your term is going to be 10 years, whatever it may be, right? With our clients, and this is where that education component comes in again, is we educate them to realize that it really doesn't matter what the rate is, right? It really doesn't matter how much equity we're able to pull out right away. All we need to do is get started with something, right? Would we like to get more than, as much as possible? Sure. But again, there may be some limitations to that. If their credit is bad or they don't have the right documentation or whatever it may be, it doesn't mean that we can't help them. It means we just might not be able to get the maximum amount that they normally would be able to get to, right? And we have ways to be able to work around that while we're, pulling that initial equity out and going into our process. So, one of the other things is obviously we have our own credit enrichment company, which is Next Level Credit. So for those that have, let's say, not stellar credit, we're able to pull out that equity and then utilize that equity to also help them be repairing their credit. So within that 6 month time frame that they're generating that non-recourse funding, we're also fixing their credit on the back end. So when it comes time to being able to be in a position to refinance or go after more equity or whatever it may be, now they're in a much stronger position because now they have that credit score that is typical, that a lot of lenders are looking for, right? That allows them to get that 85, 90%, whatever it may be.
Right.
But the other thing I want to point out is that even though you may have a low interest rate, and that's great, when we kind of go through the whole process with them and explain, this is what you could get out of it, this is what the end result could be as you're growing, your non-recourse funding over a period of 6 months or a year. One thing that I want to mention is within our process, we always make sure that whatever funding amount is coming to the client and whatever that process is moving forward, we always take into account what those payments would be or what that new monthly payment would be or what that new equity, is going to be towards them. And we always build that in to ensure that the client doesn't have to come up with any further out-of-pocket money, right? And why is that huge? That's huge because let's take, for instance, for example, we have a client that, let's say, has a 3% interest rate, and they really desperately need X amount of dollars. They want to buy this company, or they need it for expenses, or whatever it may be, right? And so, typically, we refinance the first and be able to maximize their cash out because you're going to get a higher LTV on that. But obviously, they're concerned about what the interest rate would be, because obviously it's going to be higher now. And again, on the outside, that would be very important because it'd be a new loan, you'd be locked into that rate, and you would be responsible for having to make that higher payment. The difference with our clients is, like I mentioned, we factor all that in, right? So let's just say for on an average that their mortgage payment was $2,500 a month, right? And then through, if we were able to refinance that, obviously the rate's going to be higher. And let's say now, whatever that funding amount is that we're able to pull out in equity, now let's say their new loan amount would be $3,500, right? So you're talking about $1,000 extra. Now, that doesn't seem like a lot, but to a lot of people it is. I mean, when you're talking about having to come up with $1,000 extra a month
Right.
out of your own pocket, that's where clients are just like, no, can't do it, don't want to do it, right? But when we're able to sit down and which we do with every single client, we create what's called an evaluation of offers. And we take that funding amount that we would either secure for them or they bring in themselves or a combination of whatever it may be. And then we literally break down everything, right? We break down all the expenses, what the new loan amount is going to be, what the programs are they're going to go into, what the funding is going to build. And what they're able to do over that 6 month to say a year period with not having to make that extra payment out of pocket, but still benefit, sometimes 5, 10 times the money that they're able to pull out in equity. Now it kind of doesn't make that interest rate all that important, if that
Right.
makes sense, right? And we don't want to say it's not important because obviously it is. And when they are kind of fearful about that and they want to keep that in place, that's when we're able to pivot and go look more like towards the home equity lines of credit or the second positions or things like that. And even though there's a lot of companies out there that are not in favor of second position trusts, obviously, or second position liens, we do have a number of lenders and companies that we work with that we're able to get that done for our clients. Again, if their credit's challenged or they don't have the right documentation, or it may be a lower LTV that we're able to borrow against. But again, we're just looking to get that amount started. It doesn't have to be that maximum amount that typically everybody else would be looking for.
And you made some great points in regards to, the LTVs, loan to value. Obviously, going into borrowing against a property, there's going to be limitations on how much they're willing to lend. But tell us why sometimes when we talk about rates in our world, why it's not as important because of the way we structure everything. I think it's very important for people to understand the full blueprint to success in what we do is to pay off the debt, right? So there's going to be times where we have to venture into hard money interest rate territory. Ooh, I said it. Hard money, interest rates. Those are scary for a lot of people, right? I mean, the reality is somebody going into maybe a fix and flip mentality where they're going to borrow money from a hard money lender to hedge that they're going to be able to fix their property and sell it for a profit 3 or 4 or 5 months down the road. That's usually how it's done, right? But nobody has ever really thought about utilizing this form of lending to be able to stabilize, increase their business, and get rid of debt. How has that revolutionized the market in the way that we're laying it out there inside of our eye level to high level program?
Yeah, no, great question. And the strength of their equity, as you mentioned earlier, if it's not doing anything and just sitting there, it's, as Brian refers to, unemployed money, right? And so we're always looking for ways to have our clients' money be able to get them started, but then through our non-recourse funding process, be able to, obviously exponentially grow that for them. Number one, without, any payback that's being required. And number two, first and foremost, without incurring any further debt. And so why this is important is you have to look at when we're educating our clients, we're educating them on the opportunity costs more so than what that rate may be or what that equity may be, right? So again, like you mentioned, hard money lenders, whenever somebody hears the word hard money lender, they're like, oh my God, they're going to charge 15% and how am I ever going to be able to afford this and whatever it be. But what if that didn't matter? What if the interest rate could be 20%, right? But you weren't required to have to pay that back out of pocket. Now, yes, that's technically going to come out of the funding that we're able to procure for you, and that is a cost. However, would you rather have 75% of something or 100% of nothing? Right.
Right.
And so when we're able to show our clients, hey, this is where, we're able to do something different that other people aren't, and be able to tap into that equity to be able to pull that out. I mean, there's such a large number of people out there that have substantial equity in their property and they can't touch it. And the
Right.
reason they can't touch it, typically first and foremost, is because um, their credit score isn't high enough, right?
Right.
Or their credit score may actually be okay, but they may have issues with it, right? And as obviously everybody knows, when they go to qualify, it's not always your credit score. There's
Right.
other motivating factors that depend. It could be, yeah, you could have a 700 credit score, but you could have a bankruptcy, 3 years ago, or you could have a repo or collections or judgments, or just because your score is, up there doesn't mean that you're still not a quote unquote risk to the lender, right?
Right.
And that's ultimately what the lender is looking for, is what that risk is, because they're always factoring worst case scenario is, if I have to take this piece of property back, and am I going to be able to sell it and recoup my cost, right? And they don't want to have to do that. So anytime that it's a high risk to them, they're going to pass on it. Again, even though you may have a good credit score or things like that. So
Right.
again, on the outside kind of environment, that rate is important, right? That payment is important. That time frame is important, because that's all they're looking at. Whereas we're just looking at it as a stepping stone to be able to get the client into the process, to be able to to be able to build that non-recourse funding with them, so that in 6 months, to a year, if they choose to, pay that equity loan back, they have that ability to do that. If they
Right.
choose to pay out the house, they may have that ability to do that. If they want to put it into their business, whatever it may be, that we advise them and work with them to develop what their goals and needs are. The catalyst is being able to tap into that equity now and to be able to get them started in the process, rather than, well, I'm not able to, afford it now. I'm going to have to wait 6 months for my credit to get repaired or something like that. Well, 6 months from now, you may not have a business, right?
Right.
And but at the same time, you may not take out the amount that you quote unquote want. But if you're able to take out, excuse me, if we're able to obtain an amount that gets us started, that's all we need to do. We just need
Right.
to get you in the process. And
You know,
and once we explain that to the clients, they start seeing the interest rate not as important, and things that would really matter as just kind of elements of, whatever the next step is.
you mentioned earlier, what was the name of the diagram that we set up when we get the approvals for the loan amounts?
Oh, the evaluation of offers.
Correct. So I was thinking about that because on the evaluation of offers, there's people talk about affordable housing and they don't have enough money to do a lot of different things. When we devised the eye-level to high-level program to help more people, it went beyond helping them with their businesses, because many people, a big portion of their income goes towards their housing expense and everything that goes with that. Many of the things we don't see on the credit report, like insurance payments and just so many other payments, right? Groceries, different things to live off of, right? People don't account for those on the credit report, right? When you're getting approved
Right.
for a house. So I always thought about this, and I said, well, if we were sitting on X amount of equity and we're able to put it to work in the way that we do with the high-level to high-level program, where let's just say I could turn 15,000 into a return of, let's say, 60 to 100,000, right? And in the course of that year, as we're building this out, we're now able to pay off a year's worth of insurance, a year's worth of mortgage payments. How much cash flow goes back into your pocket from your hard-earned money, right? Especially if you have a business that relies on the ins, on what comes in from that cash flow. So it serves multiple purposes in the way we structure this. It's not just to get you a loan to have a monthly payment. This is structured in a way that we're going to be able to allocate funds inside of our structure to help you see more of that money. And now affordable housing does become affordable because we're utilizing the tools of high-level finance to put you in a better spot, right? We're talking about being able to utilize equity that was not being employed to help you now live better. And by you not having that burden over yourself, now you can focus on putting the money that needs to go into your marketing, putting it into delegating and hiring more people, right? It's a domino effect that happens behind a system that nobody else has thought of. I call this being in the blue sky, right? Because try to find someone out there that's doing what we're doing is very hard. I can't even think of one. There's elements of what we have that everybody has, right? This is nothing new, but putting it together to work for you in the way that we've done it and the mechanics that we have, that's where we become, and we become different, and and exclusive, and that's why it's important to work with us. Now, we talked about it earlier about tariffs, but how is the Federal Reserve going to impact home prices over the next year? What's your knowledge? What are your ideas and your thoughts, regarding that? There's people sitting on the sideline waiting for rates to come down or for housing prices to come down. Is there any truth or validity to that, to sitting on the sideline?
I mean, in all honesty, I think the rates that we saw a few years ago, we may not see for a long, long time, if
Right.
ever.
Right.
But it's funny at the same time, if you told somebody now who may be in their 30s or, around that age, there was a time where interest rates were 18%, you know, they would probably fall off their chair because there would be no way that anybody could ever afford a house like that, right?
Right.
At that rate. But yet somehow we survive, right? We're going to survive this too. Everything happens cyclical, right? It can't always be good and it can't always be bad. There has to be good times and there has to be bad times in order to keep everything moving forward. So, years ago, when we had that 2% interest rate and that 3% interest rate, and everybody thought, oh, this is amazing. It's never going to happen. And then all of a sudden, guess what? It crashed,
Yeah.
right? And now we're back up in the fives and the sixes and possibly the sevens. And, it's hard to say how much lower it may come down this year. It may be a couple of years before it does. But again, where we try to educate our clients on is look at the ability that you have in front of you with that opportunity so that that interest rate really doesn't matter, right?
Right.
You're able to you're able to purchase things and build things based on the value. So if you want to get that, you may want to get that higher home that you've been looking for, but normally you wouldn't do it because, well, if it's going to be this interest rate, I obviously can't afford it. Okay,
Right.
well, you make that goal, and then we strategize that process with our non-recourse funding elements of how we're going to, get to that goal. You
Right.
may say, typically it would take me 5 years to get to it because this is the status quo.
Right.
They don't know anything beyond that status quo until they're able to meet with us and we show them something that they've never seen before. As
Right.
you mentioned earlier, we're not doing anything that isn't being done already in the industry. But what we're doing is we have a very unique process of putting all of it together to take that initial step and be able to grow from there. And as you mentioned, nobody else is doing that.
Right.
And so what that allows is, one thing that just to go back to something you said earlier, where you're talking about, those intangibles that people don't think about, the groceries and the gas and the insurance and all those little expenses that add up, right? Well,
Right.
what if you were in a position not to have to worry about those and have those being taken care of? What would that do for your life? It would obviously put you in a much better position, not only health wise, but physical and just emotional, right?
Right.
But think about how many small business owners start a business and actually don't make any money for several years.
Right.
Because if they're taking money out, their business is going to suffer. So they literally have to leave all that money in just to survive, right?
Sure.
And we talk about why that's important to educate them on being able to get that funding up front so that you can not only make decisions based on value, but you want to be able to pay yourself, what you're worth, because that's why you started your business in the first place. You didn't start your business just to give everything back, right?
Right.
You started your business to be able to provide that service to the public or to do a better job or whatever it is, but hopefully ultimately be able to help other people help themselves and grow and learn from there, right?
Right.
In terms of what the Fed's going to do, we don't know. And
Right.
one of the things that we're able to educate our clients on is we're aware of it, and we make and we're always looking for ways to find advantages to whatever may be going on. But like I said in an earlier episode, something is always going bad in the economy, whether it's a day, a week, a month, a year. Some markets crashing, something's happening, and yet we're still able to come out from it positively. Yeah, there may be hiccups. There's always going to be hiccups, right? But if you look at that overall picture, it's always been for our clients, it's always ended up much more positive from where they started out.
Right. Now, you made some great points. I mean, the reality is we can't sit on the sideline with fear. I mean, the markets are going to do what the markets are going to do. I've been around this for too long. I've seen some, from the tech bubble to the '08, to the pandemic, to the recent tariff ups and downs that go with that. And we keep moving forward. We're going to keep doing the right thing and helping more people. I think we're out of time. I really appreciate you, Chris, being a guest again on this show. Thanks for tuning in to the I Love It a High Level podcast. If you're ready to rise above the average, subscribe, share, and follow us for more ways to take your grind to greatness. Until next time, keep pushing higher. Thanks for tuning in to I Love It a High Level. If you're ready to rise above the average, subscribe, share, and follow us for more ways to take your grind to greatness. Until next time, keep pushing higher.